Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. While the equity bull market remains narrow, with tech leaders directionally powering indices higher, does the rest of the market make sense today? And where in this market do newer assets or newer asset allocations take their place? Where do gold, Bitcoin, and bonds of all stripes rank ultimately when we look at the leaderboard? Does their current placement hold for the months and years ahead as we settle into a space of fiscal dominance? Our next guest says that the earnings, buybacks, and margin stories are indeed underwriting stock strength despite a chaotic macroeconomic picture, though there are signs this secular bull market is a maturing one. Joining us here today to share with you his latest research and thoughts is Fidelity's Director of Global Macro, Jurrien Timmer. Welcome back. And where have you been?
I was at Burning Man for my seventh time. It was a great burn. We had a great group of people. We had 90 people cranking out 7,000 meals for the artists and the builders who bring the city to life. And so we got back a few days ago. I'm rested, decompressed, and ready to get back into the swing of things.
So, I mean, tell us just a little bit about this, because every year, I'm sure, is quite unique, and the artists come with obviously different pieces and so on to display. But how was your job any different or the same? 7,000 people to feed. That's per day, is it?
Yes. Well, actually, we can pull up slide one. So our job is the same. So we're called Feed the Artist. You can see that in the lower right. And by the way, that logo doesn't mean we burn the food. It means that the food burns in our bellies, creating energy. We were started in 2007, not by me. I took over the camp in 2019, and we're there to support the artists who come a week earlier, a week before the burn happens, to build their art. And you can see some of that in the color picture there. That's just a typical night on the playa. And there are always things that happen that are not by design. And in this year we had some rain, but we also had a very large dust storm. You can see me in the left there, helping to hold down our shade structure, because you get this dust storm that are whiteout or even blackout, like it turns dark because there's so much dust in the air, and the winds kick up to 60, 70, 80 miles an hour, and it blows away camps. It didn't blow away our camp, but those can be a little scary moments. But we have a great group of people from all over the world, and we produce a lot of meals, and we make a lot of artists and other people very happy doing so. So that's what we do. That's our mission. That's our service, and that's what makes us keep coming back.
Would you say there's always something that people learn from an experience? Was there a thread that you would point to that you'd like to share?
Yeah, I think of it as a ritual of resilience, right? Because it's not meant to be easy. It's not supposed to be Coachella where you just show up and listen to your favorite DJ. It's supposed to be hard. There's always a time in the middle of that week where you just want to go home. And so it's by design. And so it makes us better. And we very carefully curate the group of people that come to camp. Everyone has to work in the kitchen, and it creates a very close-knit bond. And for me personally, it sort of is a grounding reset every year, because it's about immediacy and impermanence and growth. And I think we all come out of this a little better than how we started. And overcoming whatever obstacles the playa throws at us is part of that journey.
Right. Oh, it's absolutely fascinating. Well, we're delighted to hear about this, and to also have you share with us some of what you've seen in the market since you've come back. So, I mean, you had a period of time where you're probably completely off the grid in terms of knowing what's going on in markets. What do you think now that you come back?
Yeah, well, it's always so I do have a Starlink there, because I had to check for the weather, but I was off the grid market wise. I put in my out of office reply, and I never checked the markets once in 2 weeks, which was refreshing. And it also worked out well because nothing really changed so much in the market. So while I was there, But then, I open up my computer when I come back and I download all my charts, and it is kind of nice to have a fresh look and to see, okay, is what I thought made sense 2 weeks ago still the case? So you kind of have a look at charts with a fresh pair of eyes, if you will. But basically, the same things that I was thinking in in August, I'm still thinking in September, and that is that the bull market is alive for equities. It is fueled by re-accelerating earnings, which is a very important part of the story. So the bull market's alive. The global rotation is still very much alive as well. I mean, especially non-US developed stocks, very, very competitive now for a change. For years, that was not the case. Bond yields are down quite a bit. They're near 4% because as you well know, the unemployment data has been soft, and that has, pivoted the market towards expecting more rate cuts. And of course, the Fed's fate as an independent central bank remains somewhat in question as Jay Powell retires next year and gets replaced by clearly someone who is going to look at things more favorably to what's happening in Washington. But that's nothing new either. And then, gold has broken out of yet another continuation pattern, and Bitcoin sits near the all-time highs. So, in many ways, the themes that we have been discussing over the last 6 to 12 months remain intact, and we go forward.
It's fascinating. So to an extent, when you ask the question, do things make sense? They make sense as much as they did a couple of weeks ago. And I think you have a leaderboard, which is always interesting to take a look at, to sort of go back and see which asset classes, in fact, are leading the way.
Yeah, so we'll go to slide 2. And so, yes, so the leaderboard is essentially the same as it has been for the last few months. So at the top, gold, European equities, developed equities, EM equities, Japan. Those are all at the top. And then you have Bitcoin, and you have, of course, large cap US growth, which is the Mag 7. And so that to me all makes perfect sense, right? The S&P obviously is fueled by the AI boom, which is very much real. So that's where large cap growth comes from. The mean reversion away from US towards non-US is very much real, but it's happening in a way where the pie is getting bigger, right? So this is not a zero sum mean reversion, which is something that I was worried about a year ago, for instance, that if the rest of the world was going to outperform, that meant that the Mag 7 had to go down. And if the Mag 7 went down, the US market would go down, and it would be a zero sum kind of rotation. That has not happened. So this is a rotation that's happening while basically all asset classes are going up, right? You look at that chart on the left there, everything is positive. And so that's pretty remarkable. And obviously that's a very nice outcome, because that means that not only if you're in this trade are you getting the alpha, but you're also getting the beta, and that's a very good thing. And then, of course, at the top of the chart, which is the bottom, you have bonds, and so that is part of the same trade, right? So it's gold versus bonds, it's non-US versus US, but in a market where the rising tide is lifting all boats. So pretty much this makes a lot of sense to me, and I suspect that it will continue.
It's completely fascinating. And one of the other things that you talked a lot about was sort of the idea of payouts, of dividends, of being a time where actually the total return was going to be very, very important to investors. That said, there's a huge amount of just growth in the market right now. I'm kind of wondering if we can swing back to that. Are they both important to the same degree?
Yeah, so if we go to slide 6, so obviously the tariff tantrum in April seems like ages ago, right? But the tariff tantrum caused analysts to mark down their earnings forecast for stocks all over the world, but especially in the US. And then we had the big, beautiful bill. And of course, we had the administration walking back from the more scary tariff stories, tariff scenarios. And so that allowed earnings estimates to actually reaccelerate higher. You have to kind of squint to see it, but if you look at the lower right, the blue bars, you can see that earnings growth was at 10, it went to 7, and now it's back at 10. So it ended up being a hiccup, and we don't know if that's the way it's going to end up turning out because we haven't really felt the full brunt of the tariff tantrum yet, and we don't know to what degree it will be absorbed by consumers paying higher prices or producers or importers paying getting lower margins. But at this point, that was sort of a passing storm, and the big beautiful bill I think is more than making up for it. And just to illustrate that, if we go to slide 7 and you look at earnings revisions, you can see a massive reacceleration there in the bottom right there. We went from the earnings revisions index, which is upgrades minus downgrades as a percentage of estimates, going from -12 to +12 just in the last few months. So that is a pretty impressive acceleration in earnings momentum. And that's very important because you want bull markets to be driven by earnings, not by valuations. Now, adding to that, and this is very counterintuitive, if we go to the next slide, you can see that the operating margin for the S&P is now at a new high of 14%. And again, back in April, the very obvious conclusion in the market was, okay, we're going to have tariffs, right? The tariffs are going to go to like whatever, 20%. That's going to eat into profit margins of companies, and it would, like it should. But again, it's always a nuanced thing. The answers are never as sort of simple as we would like. And so instead, margins have actually gone up. And again, I think that is in relation to other things, right? It's the AI boom, it's the big, beautiful bill. And maybe the margin story will still come from tariffs down the road because not everything has been felt. And as you know, companies were over ordering before the tariffs went into effect. So we don't know how long this will last, but you get earnings accelerations in terms of estimates, you get higher margins. And when you have higher margins, if we go to the next slide, oh, sorry, where's the next slide? Slide 10, sorry. Um, that explains the difference between a price to sales ratio, which is the orange line, now going to new all-time highs, well above the dot-com bubble levels, while the price to earnings ratio, which is very high at 25, being below their highs. So obviously the margins is what makes that difference between sales and earnings because you're keeping more of your sales as earnings if your margin is up. And now, but to your question about buyouts, if we then add another layer of this and we go to slide 9, you can see that share buybacks are also at a new all-time high, 293 billion over the last 12 months. And so there's a lot of powerful things moving, right? You have earnings growth reaccelerating, lots of upward revisions, higher margins, uh, bigger share buybacks producing a higher payout. And so that's a lot of positive momentum. And of course, the counterbalance is that we're paying a lot for those earnings because the PEs are very high, but but this is kind of the momentum that the markets are feeling. And we can talk about non-US markets and how they fare on this as well. But this is a pretty good backdrop right now for where this momentum is coming from.
I mean, where international markets sit versus these powerful gears that you're talking about here are actually quite similar, aren't they? I mean, there's powerful gears giving to the valuations that we see across the globe as well.
Yeah, so if we go to slide 17, so one thing I think it's always good to remember, so when we look at US versus non-US, um, oftentimes people will focus on the valuation difference, right? The US is at 24 times earnings, rest of the world is at 15 times. So obviously you pick the rest of the world because it's cheaper. It's never that simple, of course, because the markets are very efficient. And there's a reason why the US is at 24 and the rest of the world is at 15. Like the markets are not irrational, right? So, and then you get into the math of, okay, what is the earnings growth? What share of those earnings are return to investors as dividends or buybacks. So you can think of that as the return on equity to investors, right? So if earnings are growing at 20, but companies are not paying any dividends or they're not buying back any shares, then okay, it matters, but it doesn't matter as much as if companies were returning some of those earnings back to shareholders. So when you look at a discounted cash flow model, typically we look at the growth not in earnings, but the growth in the payout. So the payout is again dividends plus buyback. So in this chart, the payouts are showed for the US, EFA, so non-US developed, and emerging markets. And you can see that in all three cases, the payout is growing. And then at the bottom, I show the payout ratio, so the percentage of earnings returned to shareholders. And what you can see is that EM, of course, EM is generally behind because these are emerging companies. They don't tend to pay as much in a dividend or in a buyout because they tend to be more dilutive because they're younger companies. So that tends to be a lower payout no matter what. So that's a 45% payout. But if you look at EFA and the US, they're both at 76%. And then if you look at the growth, like the orange line and the gray line at the top, the EFA payout actually is growing faster than the US payout. And so this is an important difference that we haven't had in the past. And actually, we can go to slide 18 to just show that in a little bit more detail. So on the left is the US, on the right is EFA. So until about a few years ago or even a year ago, we had the situation where, okay, the US was very expensive, the rest of the world was not. But the US had the earnings momentum, right? It had the Mag 7, it had the AI thing, it had a more growthy configuration, and it had a higher payout ratio, and that payout was growing faster. So yes, it was more expensive, but it was justified. Now, the payout is about the same, although as you can see from the chart in the bottom, in Europe and Japan, more of the payouts coming from dividends and less from buybacks, whereas in the US, it's the other way around. But that doesn't really matter too much. But the payout in Europe and Japan is growing faster, while the valuation remains much, much cheaper. So this is a very competitive market now, EFA versus US, and you're getting the difference in valuation. So you have both a valuation difference as well as now a catalyst. So to me, that suggests that the mean reversion that we've had, right, going back to that leaderboard, you see that non-US stocks are at the top. I think this will have some legs, and this is a longer opportunity. And then, not to belabor the point too much, but if you then add the currency element to that or dimension to that, where maybe the US Fed becomes less hawkish and more dovish as it emphasizes employment growth over inflation, that suggests that the dollar could remain in its weakening trend. And then, of course, you get currency translation on top of the fundamentals that I just described. So to me, this is pretty low-hanging fruit, and I would definitely favor developed over EM. We can just go to slide 19 real quick. That shows the same chart, but now for emerging markets. You can see that that is not as juicy an opportunity set, right? The payout is not growing as much, and the payout ratio is much lower. So to me, this is a potentially a lasting trend that should help investors generate not only beta in the market but also alpha.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
That is absolutely fascinating, and focusing, as you say, on the payout ultimately, rather than the valuation story, which is, something that we used to do all the time, but maybe those days are gone for at least a little while. The fly in the ointment is jobs. This was discussed at Jackson Hole, which maybe you were hopefully not tuning into because you were actually somewhere else. But the shift happened then. We've then had a slew of jobs data over the course of the last sort of week and a half, showing that this is absolutely a shift towards the employment mandate seems to be warranted by the data. That is also helpful for what the administration wants. I guess just to the critics who would say a shift to the employment story helps you cut rates, which is kind of what the administration is going for. I guess, how do you address the critics to say that's sort of useful?
Yeah, so if we go to slide 20, I think this is an important shift in the narrative for the Fed. So obviously we know the political dimension, right? Jay Powell is stepping off as the chair next year, and someone will take his place who is going to be much more, let's say, favorable to the administration's position that rates are too high and should come down. And so that gets you squarely into the fiscal dominance kind of mode where the Fed becomes less independent. It doesn't mean it loses all of its independence, but it becomes less independent and is going to maybe favor the growth mandate more than the inflation mandate. So we know the Fed has this dual mandate, full employment on the one hand and price stability at 2% on the other. We've certainly had moments in the past, especially the 40s, World War II, but also the 60s, where the growth mandate was just deemed more important. And that gets you into a fiscal dominance mode. And so the reason that's important, because if we look at this chart here of the Fed forward curve, which is now dips down to below 3%, and we compare that to what I would consider to be a neutral rate, which would be inflation plus 100 basis points, 100 basis points being R star, you get into the high threes, not the high twos, right? So the market is expecting the Fed to cut basically down to the inflation rate, which would be a accommodative posture. And I think the reason for that is twofold. One, if we go to slide 22, is of course the fact that the jobs report has been soft the last few months. And the other one is the political dimension that I just mentioned, where the Fed is just going to be more dovish than it otherwise would be because it wants to lower rates in order to help finance the deficit. But if we look at the top panel here, that is, it shows two lines. One is the unemployment rate relative to what we consider to be the natural rate of unemployment, or we used to call it NAIRU. And that's at zero, which means that the labor market is in balance. The other one, the orange line, is from the JOLTS report, and that's the excess labor demand. So the number of job openings versus job seekers. That, of course, went way up in the aftermath of COVID because the economy reopened and the labor force was not there to accommodate that. So you had a very tight labor market. That is also down to zero. So on the surface of it, the labor market's exactly in balance, right, in terms of the demand for labor and the supply of labor. But of course, you look at this chart and the pendulum never stops right at zero. It always overshoots in one direction or the other. And you look at the past cycles and you could argue, okay, yes, it's at zero, but it's moving down. And that means that the next phase of this is going to be a contraction in labor. And I think that's what the market is looking at in terms of what the Fed is likely to do. And that's why bond yields are down to 4. But it doesn't really explain very well why earnings estimates are being moved higher and why the stock market is strong. So there is a little bit of a disconnect between those two. But I think when you look at the Fed lowering, or the Fed expected to lower rates starting in September, which is just around the corner, and then a new chair next year maybe lowering rates more, my sense is that we're going to move into a regime here where if in the old regime neutral was inflation plus 100, the new neutral, as I might want to start calling it, would be more the inflation rate as being neutral, which would be less than it normally would be. And that is not necessarily a terrible thing. The risk, of course, is that it unanchors inflation expectations over the long term. So we might have higher inflation as a result of it. But for the stock market, it might not be so bad. It might actually provide fuel for further rallies. And of course, for gold and Bitcoin, it's good. It would probably cause a yield curve, the yield curve to bear steepen. So probably not great news for long bonds, but good news for short rates, and therefore also for banks, because banks like a steep yield curve. So no matter what happens, there's always a menu of things to choose from that will either be helped or hurt by whatever it is we're seeing. So I always want to emphasize that we want to look at this as an opportunity set, even if it might have some long-term implications.
Yeah, it's absolutely fascinating perspective on it because, as you say, it's there's lots there to actually invest in that may well benefit from that. A couple of questions coming in, one on gold and international, which I think you've touched on quite a lot. The other is a discussion of what phase, maybe cycle, of the market are we in? Is this the speculative phase, would you say?
The latter one is a great question, and we'll go to slide 15. When you have an AI boom and you have a lot of fiscal policy stimulus and potentially a fiscal dominant stimulus where you have fiscal expansion accommodated by monetary expansion, I don't want to call it monetary expansion, but less of a monetary restraint, you can argue that the animal spirits will take over. And exhibit one for that is this chart, which is the Goldman Sachs non-profitable tech. And it's not really doing that much right now, but you can see, the 2021 on the left was that easy money bubble when the Fed kind of overstayed its welcome with accommodative policy, and we had all the fiscal stimulus from COVID. And that turned into a little bit of a bubble, and then that bubble burst, and these stocks went down, 75% from 433 to 93, and now we're at 186. But this would be the chart that I would follow to measure whether we are in a liquidity bubble again, or whether we end up in one. And when we think about the secular trend, that actually would be a fitting end to the secular bull. So if we go to slide 14, actually go to slide 12, sorry. We've talked about the secular bull market many times, and this one is 16 years old by my count. The past two got to 18 years old. And so we're kind of in the final innings, but you can see like the orange line was the 60s, and that ended with a whimper, and the blue line was the dot-com period, and that ended up with a bang, of course. And so, how this one will end was always been, an area of interest to me. So if the AI boom turns into an AI bubble, then obviously the blue line would become the one that I would watch. And if we go to slide 13, we just show this a little bit differently, where I'm looking at the very long-term trend, the 150-year trend, and then in the bottom, I look at the deviation from that trend. You can see kind of the 60s was a series of accelerations above its trend line, whereas the late 90s was just one big sudden bubble. And so far, we're kind of following the 60s, where we're about 50% above the trend line, but not 100%. And so anyway, this is kind of, more for entertainment purposes, but it makes me wonder how this thing could end. And certainly a blow off in the coming couple of years is one certainly legitimate scenario that we should be on the lookout for.
And this is sort of the maturity that you've been discussing within the bull market, but as you say, still probably further to run. I think we'll have to leave it there and catch up with you next time. Jurrien Timmer, delight to see you as always. Thank you so much for sharing your knowledge with us.
Thank you very much.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.